Hello folks, and welcome to the final frontier of personal finance, investing. Now investing is simple, not easy, but it is simple. It is we who complicate it by overthinking, overdoing and setting expectations that are unrealistic. Now there are 5 golden rules of investing, and trust me, if you follow these rules, you will be better than 99% of the investors out there. Number 1, don't pick stocks. In fact, generating outsized returns by investing in individual stocks is almost impossible. Now here's a fun fact. Around 90% of large cap mutual fund managers were unable to beat the returns of S&P BSE 100, which is a large cap index. Now these fund managers had almost unlimited resources and research to help them out. They had degrees from the best business schools as well as CFA certifications. Yet they failed to beat even the benchmark. So what chances do average investors like us have? Now you must be wondering, what is the alternative to stock picking? The alternative is to invest in low cost index funds and ETFs that track the benchmark like Nifty 50. These are the very same benchmark that these fund managers fail to beat. Number 2, start investing early. Let's say we have an early investor and a late investor. The early investor starts investing rupees 10,000 a month at the age of 25 and he continues to do so till the age of 60. The late investor too starts investing rupees 10,000 per month and he continues to invest till the age of 60. But the late investor starts investing at the age of 35. Now, if we assume that both investors grew their money at a rate of 12% annualized till the age of 60 years, then the late investor made an amount of rupees 1.9 crores after a period of 25 years. That's pretty impressive. However, by starting 10 years earlier at the age of 25, the early investor made an amount of rupees 6.9 crore. That's almost 3 times the amount made by the late investor. Isn't that insane? So start investing early. Start today. Even a delay by a few weeks or months can make a difference of lakhs of returns to your portfolio. Number 3, invest for the long term. The stock market is very volatile. If you put your money in fixed deposits, you know well in advance about the type of returns that you're going to make. In stock markets, because of the volatility, this unfortunately is not possible. Many have tried and failed to time the market or make abnormal returns by hopping in and out of the market based on instinct or even data. There is a simple solution to tackling the volatility of the market. Invest for the long term. Let's consider 3 time periods: 1 year, 5 years, and 10 years. Now, if you would have invested in the Nifty 50 index for a period of 1 year, your returns would have ranged between minus 35% to 85%. Isn't that some level of volatility? Simply put, if you would have put your money in the Nifty 50 index, your returns would have been highly unpredictable. That could have ranged from as bad as negative 35% to as superior as 85%. Now, if you would have invested the same amount of money in the Nifty 50 index for a period of 5 years, your returns would have ranged between minus 3% to 37%. Still a lot of volatility, but better than investing for a 1-year period. And finally, if you would have invested your money in the Nifty 50 index for a period of 10 years, your returns would have ranged between 5% and 19%. Now that's an acceptable level of volatility and is fine with most investors. So as the investment period increases, 2 things happen. Number 1, the chances of you making negative returns are significantly lower. And number 2, the returns that you're likely to generate are more predictable. Number 4, diversification. Don't put all your eggs in one basket. That's diversification. What it means is that don't just invest in one or few of something. Don't invest in one or few stocks, or just in one investment asset class like stocks. In the next video, we will see that there are many investment classes out there, and using a combination of as many as possible will be of great benefit to you. But let's look at a couple of other golden rules of investing before we talk about diversification. Low cost is your best friend. Investing isn't free. There are no free lunches. If you're investing in mutual funds, the mutual fund company charges you a fee. If you are picking stocks, you have to pay a brokerage. If you are asking someone else to pick stocks for you, you have to pay them an advisory fee. The investment management industry will charge you even if you sneeze. But the higher fees translates into superior performance very rarely. In fact, in most cases, this fee ends up reducing the returns of your investments, and the fee which could have been invested into stocks now finds its way into the pocket of your advisor. All you gotta remember is to be aware of these fees and charges at every stage. Actively finding ways to reduce it will help you grow your money and investments over the long term. Active mutual funds have a fee of about 1%. PMS or portfolio management services have a fee of about 2.5%. ETFs, on the other hand, have a fee of just 0.1%. But more importantly, ETFs track indices that are unlikely to be beaten by professional and portfolio fund managers. So you don't have to be a rocket scientist to see that how investing in low-cost ETFs can be your best bet in generating maximum returns from the stock market.